Hello and welcome to the Livestock Marketing Futures Market and Hedging Basics module. My name is John Michael Riley. I'm with the OSU Department of Agricultural Economics. And as the title indicates, this is an educational module on futures markets and then how we can use those markets from a hedging perspective. So to get started, I just wanted to start out by discussing futures markets in general. And then the next set would be kind of how we can use futures markets from a livestock hedging base perspective, and then lastly conclude with other ways that we can use futures markets within our marketing plan. So, as to let you know, futures markets are contracts, and these are legally binding agreements, and it is to buy or sell some commodity. We're going to focus on livestock commodities, commodity futures. But again, if you do enter into a contract on the futures market exchange, then you are agreeing to buy or sell some product. These markets are governed by a futures exchange, and so that is the overruling body that ensures that everybody that uses futures contracts are playing by a specific set of rules. Again, these are contracts. It's an obligation to buy or sell. You can buy and sell futures at some specific date, at some specific quality, at some specific quantity, and then at some specific location. All of this is at a negotiated price. So everything in that contract is determined by the exchange, and everything is non-negotiable except for the price. These are very similar to a forward contract if you've ever used a superior auction, or if you've contracted with an elevator to forward price grain or livestock. Then futures contracts are very similar in that regard, except that it is handled through an exchange instead of through two individual parties. So why do we use futures? Well, there's a number of reasons that people use futures. We're going to focus on why hedgers use futures, which is a different use of this marketplace as opposed to someone like speculators who are there trying to make money. But hedgers are wishing to protect their price. They're wanting to protect their underlying product from some adverse price move. Hedgers do own the actual commodity, so if you own livestock and you use futures markets, then you are considered a hedger. Again, you're using this to protect against price risk or adverse price moves, and more often than not, you're going to offset the position in the futures market at the same time that you buy or sell the commodity in your local cash market. So the futures market is really just holding your price until you actually do follow through with your cash market transaction. Hedgers, again, use this to minimize price risk. The whole purpose of using futures or forwards in a marketing plan is to minimize price risk. So essentially, the goal here is to lock in a price. I want to emphasize that hedging is not a couple things that hedging is not, and this can sometimes befuddle some producers because they feel like if they lose money in the futures market, then they're not doing a good job with their management plan. But hedging is not an effort to increase profits. So anyone that is using futures markets to try to make money, you're moving away from being a hedger and into being a speculator. It's also not an indicator of poor or superior management in that if you do lose money in the futures market, then as I'll hopefully indicate to you later, what you've done is you've essentially made money in the cash market and vice versa. So if you lose money in the cash market, then you've made that money back in the futures market. So again, you're locking in a price, and it has nothing to do with trying to make more money, and it has nothing to do with being a good or a poor manager. Some mechanics here. So again, this is a transaction that will happen at some point in the future. When you trade a futures contract, whether you buy or sell, you are promising to either buy or sell that actual product in the future. Again, these contracts are legally binding, so you are telling the other side of that trade. If you're selling, you're telling the buyer that you're going to deliver some product. If you're buying, then you're telling the other side that you're going to accept some product in the future. I think a good example of this is to think of a reservation at a hotel room. I suspect many of us have made these reservations before. We call the hotel or we get online and book a hotel room at a certain price, and then we don't actually stay in that hotel room until some point in the future. And when we show up to the hotel, the price that we've locked in essentially, either through our phone call or through our reservation, is still that price. If we get to the hotel and the rooms on that day are cheaper, well, then we kind of feel like we shouldn't have made the reservation earlier. If we get there and the hotel rooms are more expensive, then we feel like we've done a good job and we've reserved it at a lower price. So at the end of the day, you're not going to stay in that hotel room until some point in the future, but you're making that reservation today. And we think that I think that's a good example of how we can use a futures contract to lock in a price. For futures hedging to work, one of the things that has to happen is that cash and futures prices must move together. Again, a futures contract is a promise to buy or sell something out in the future, but it is representative of some actual product. In the case of this module, we're going to think about livestock. That's not to say that these cash and futures prices have to move, one for one in lockstep, but they definitely have to be similar, or they have to move together in some way, shape, or form. To think about that, here's just two pictures to kind of help tell that story. Up in the top left, we've got corn prices, cash corn prices for Dodge City, Kansas, and then the December corn futures contract from 2015. Again, it doesn't really, don't get too hung up on the fact that it's 2015. Just mainly the point here is to indicate that we see the black line there being cash prices and the orange line the futures prices for that specific year. And throughout the year, those prices, although they didn't move, they weren't lined up with each other, and they didn't always move in the same exact pattern. At the end of the day, they when futures markets were going down, cash market was going down. When cash market was going up, futures market was going up, vice versa. So they were moving in the same direction. Similar with the feeder cattle futures in the Oklahoma City, 700 to 800 pound steers. Again, they weren't right on top of each other. The black line and the orange line there's a little bit of separation. Sometimes the separation is a little wider than at other times of the year, but for the most part, they moved together. So again, as long as they move together, then hedging will work, and we can think about the relationship between cash markets and futures markets as basis, where basis is defined as cash price minus futures price. So whatever your local cash price is, you take that and then subtract from it the futures market price on whatever given day, and that's basis for your local market. And this is an important concept that we're going to keep kind of building on. But again, just remember, basis is cash price minus futures price. So to think about why we're trying to lock in price and why we're trying to use futures markets to protect ourselves against an adverse price move, essentially what a hedger does is they give up the price risk and they accept basis risk. And these two charts, or these two lines here, give an indication of why that's important. The blue line, as you can see, is very spread apart. It ranges anywhere on the low end from $65 a hundredweight all the way out to $165, $175 a hundredweight. That's a really big range of prices that have occurred between 2002 and 2015 after you adjust for inflation on these live cattle prices in Texas and Oklahoma. Over that same time period, basis, which is the Texas-Oklahoma cash price for live cattle minus the live cattle futures contract price, the basis there, the range of basis outcomes over that same time period was much smaller. So the basis risk that a producer over this time period would have been under was much smaller than the price risk, and that's why hedging is very effective. As long as those prices move together, then basis is typically smaller, or basis risk is typically smaller than cash risk. So now let's really get into the kind of dollar signs of the futures market. We think about futures contracts. They're highly specified. Again, everything is locked down in that contract. Everything's specified except for the price. The price is the only thing that's negotiated. So we can think about the total value of a contract as being price times quantity. Quantity is already specified. All that's negotiated the price. So for example, the live cattle futures contract is a 40,000 pound contract, or 400 hundredweight, however you want to think about it. So if on any given day the price is $1.15 per pound, we can think about the value of that contract being the quantity, 40,000 pounds, times the price, $1.15. So a total contract value of $46,000 for this example. And another thing that can get some producers hung up is the fact that is this idea of margin. All right, so futures contracts are margin based, meaning that you don't have to send the exchange that full $46,000 from the example there. You don't have to send them that full amount. You just send them a portion of that, just as good faith money to ensure that you're going to fulfill your obligation. Typically, margins are 2 to 8% of the contract value, depending on the contract that you're trading. Really risky contracts are going to have a higher percent that has to be sent to the exchange for margin. Think about risky contracts like crude oil, and then your lower risk are typically have a smaller percent that has of contract value that has to be provided to the exchange. If we look at what live cattle margin was around early 2017, early 2017, the marginal live cattle contract was $1,750, or based on that $46,000 amount, about 3.8% of the value. Margin means that you're leveraging yourself, so you're sending the exchange a small amount of money to control a large amount of money. That's both good and bad. It's good in that you can use these tools with a very small level of investment, but at the same time, prices move against you, then you can get into some financial stress pretty quickly because of this. So let's go into an example of how we would use futures markets to hedge, and keep in mind that forward contracts are very similar, and so anytime I talk about futures, you could easily incorporate a forward contract here and it would have the same impact. So let's think about before we hedge. Let's consider a time when no price risk management tool was used. As prices increased or decreased, the value of your product, if it's your cattle here that we're thinking about, then the value of your cattle fluctuated with the price. So for example, if when you made a management decision to background some calves and those were priced at $1.50 and then the price dropped to $1.30, well, essentially the value of your calves declined by 20 cents a pound. Carry that across however many head and however many pounds, and you can figure out the total dollar amount that was lost there. Of course, it could move the other direction, and if prices moved up, then the value of your cattle increased. So if we think about hedging versus not hedging, this graph looks like the text is, or the font kind of got a little tight there, but on sell day, if you sold your cattle at $1, then you actually received $1 for those cattle. If you sold your cattle at $1.40, then on sell day, then the price that you realize is $1.40. And I'll just give one more example. If you sold your cattle at $1.90, and then the price that you realize for those cattle is $1.90. Again, not breaking any calculators here with that, but essentially the price that you receive is the price that you actually put in the bank. So if we go to, let me get that out of the way. If we go to an example now where we actually incorporate futures or again forwards, let's see how that would work out. So now let's consider a hedge at the onset of your backgrounding phase. As the cash price increases or decreases, since, again, going back to this idea that cash and futures need to move together, the value of your product is stabilized because of the hedge. And we'll see how that works here with this example. So in early October, you buy some cattle, you're going to winter graze them. After the grazing period, you sell your cattle in March at approximately 700 pounds. So that's just kind of the setup of our example here. We can spend a lot of time here. I don't have enough time to really get into the hows and whys, but essentially we would choose the March contract because that's the contract that's closest to the time that we're going to be selling these winter grazed cattle. The March futures contract price in October, when we initiate our production practice here, is $1.17 per pound for my example. And based on this information and based on information that you've collected or on basis, you've kind of looked at historically what basis is for March in your area, and you found that to be negative 15 cents, which means that cash prices are 15 cents below the futures market, based on that cash minus futures formula that we discussed earlier. And so again, if the futures market is $1.17 and you expect the cash market to be 15 cents below the futures, then you're looking at receiving $1.02 per pound for your cattle. So that was in October. Now we've moved forward. We jumped forward in time. Now we're sitting here in March. Our cattle are done grazing, and we're going to sell the cattle. So we take our cattle to market and we sell them for 96 cents per pound for a cash price. On that same day that we sell those cattle, the March futures contract is $1.03 per pound. So how then does that work with our hedging? So actual basis here in this case was 96 cents, or excuse me, was 96 cents was what we sold the cash cattle for. $1.03 is the futures market. Going back to that formula from earlier, cash minus futures, our actual basis is negative 7 cents. So we expected to get negative 15. That's that basis risk that we accepted, and we didn't take the cash price risk. So our realized price here is our cash price minus any gains or losses in the futures market. So if we put the numbers to it, that's 96 cents cash price, and then we subtract out the $1.17, that's what we sold the futures contract at, and then $1.03 that we bought the futures contract at. So our realized price in this example is $1.10. All right, let's go the other direction. We sell our cattle in March at $1.24 cash, and the March futures contract is $1.31. How does that work out? Again, cash minus futures, 124 minus 131 is that same negative cents. I did that on purpose just to kind of keep it simple for now. And now our realized price is still cash minus futures gains or losses. So our cash price is $1.24, and then we subtract out the price that we sold our futures contract at, $1.17, minus the price that we bought the futures contract back at, $1.31, for that same $1.10 price. So we sold the contract, a futures contract, in October, and then we offset that contract in March, and then we went to the cash market and sold our actual cattle. That's typically what happens when we think about hedging with futures. So now if we look at this graph one more time, we can see that here was our cash prices on sale day and actual outcomes that we put in the bank. Sold our cattle at 50 cents, then we're going to get 50 cents for our cattle. Sell our cattle at $2, we're going to get $2 for our cattle. Well, here when we hedge, because of the relationship between cash and futures, every time, no matter, even if we sold those cattle at 50 cents on sale day, because of our offsetting futures market transaction, we get $1.10 for those cattle. If we sell our cattle for $1, we would have received $1.10, because anything that we lose in the cash market, we're making that money back in the futures market. Any money that we would have made in the cash market, we're losing that money in the futures market. So everything that kind of levels everything out to $1.10, and that's why I talk about futures and forwards, you're essentially locking in a price. So in this case, we locked in a price at 110. We expected our price to be 102. If we think about the onset back in October for this example, because of the basis being a little bit different than what we expected, it ended up being locked in at 110. So going on beyond hedging, we can think about futures markets as a useful tool for more than just hedging. That again, going back to that relationship between futures prices and cash prices, futures prices can provide a very good forecast of what we can expect to see in our cash market for the time that we're planning to buy or sell. So if we use futures markets near the planned marketing time period, we can think about an estimate of basis, where basis is cash minus futures, and an expected cash price can be determined using that same relationship. So going back to that basis formula from earlier, cash minus futures is equal to basis, we can just essentially rearrange these three, and we can put basis on one side of the equal sign and cash on the other, and we get futures plus basis equals cash. And just to kind of let you know what basis patterns here in Oklahoma have been for the past number of years, this might look a little messy at first, but give me just a moment to kind of indicate what's going on here. This solid orange line with the white dots is the average from 2000 to 2016, and then the black line is a more recent average from 2012 to 2016. And then the gray line is what we saw in the most recent complete year of 2016. The dashed lines are just an indicator of a standard deviation above and below, which is an indicator of some low expectations and high expectations. The black line, as you can see, is up near the top end of that standard deviation line, which tells us that from 2012 to 2016, we've actually been experiencing a higher than expected basis over the entire year in Oklahoma. But again, the pattern is very similar. We think about starting the year in January, basis typically moves higher for these lightweight calves. moving from about $30 above the futures market to just below $40 ahead of the futures market. And then as we get move into April, and then as from really April until the middle of the summer, basis typically decreases from that kind of high 30s mark down to just a little bit above $20. And then it moves up a little bit as we start moving through the tail end of the summer. It drops off as we start the fall, but then once we really get into that fall run, these lightweight cattle typically increase relative to the futures market. Now, the 2012 to 2016 basis, again, followed a similar pattern. However, it was at an elevated level relative to the longer 2000 to 2016 average. Switching gears, looking now at 700 to 800 pound steers here in Oklahoma. It's a lot messier. Obviously, there's a lot more ups and downs here. And the gray line in 2016 just seems like it was on a roller coaster, no doubt. But let's keep in mind that we're not dealing with a range of basis that is from that previous graph. Now, for the most part, we're looking at positive $4 to really negative $2. So about a $6 range of basis outcomes here, from negative 2 to positive 4, cash price relative to futures price. So even though it does jump around quite a bit, we're thinking about a number that is much closer to zero than the previous graph. So again, the pattern isn't quite as distinct, but for the most part, the basis for these heavier weight steers in Oklahoma are very close to what the futures market is. Cash prices are typically very close to the futures market. And then lastly, the last graph to show here in terms of basis pattern is Oklahoma 400 to 500 pound heifers. And again, this is, I don't know if I mentioned it earlier, but these are an average across all of markets in Oklahoma. And the basis pattern kind of presents itself again much more like the 400 to 500 pound steers. Here with heifers, the longer average, we see that at the start of the year, lightweight heifers are very close to the futures market price. They move higher like they did with the steers up until late March, early April, fall off as we head into the summer, continue falling until we get into the mid to late fall time period, and then we close out the year with basis moving much more positive, again, for heifers here in Oklahoma. So again, the black line is a shorter period, the orange line is a much longer time period. I've been quick, and I've really probably haven't done this enough justice, because it is a heavy topic. It's one that deserves, it takes a lot of time to get your head wrapped around. I've tried to do that in a very short time frame, but I encourage you, if you haven't already looked at some of this material, here's some websites that you can go find more information on futures markets and hedging with futures. Thank you for joining me, and I hope that you've gotten something out of it.